Trading Options 101, the basics. We always appreciate the support for our content and channel to grow. So if you made it this far and enjoy using our content to grasp learning options and taking control of your finances and investments, please like, comment, share, and subscribe. Let's recap our key terms we can't forget. Strike price, the agreed upon price at which the stock will be bought or sold. Expiration date, the specified date at which the option contract will expire. Alright, let's recap our understanding of calls and puts. Understanding call and put options. A summary of how options function. There are two types of options that can be bought. This is considered being long on a position, and so this is considered being short on a position. A call option and a put option. Now, most investors are buyers or long on positions. Thus, for buyers of a call option, you are bullish on a trade, which means you anticipate the stock price to increase. For buyers of a put option, you are bearish on a trade, which means you anticipate the stock price to decrease. Let's do a quick recap of our long and short calls and puts. The long call option gives an option holder the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a specified date. The long put option, typically one of the first entry-level option trades people will place if you are bearish on a stock, meaning you are anticipating it to decrease. The long put option gives option holder the right, but not the obligation, to sell shares of stock at an agreed upon price on or before a specified date. The short call option, a bearish trade. You assume the obligation, not the choice, to sell the underlying when the call buyer exercises his option. The short put option, a bullish trade. Thus, understand when short selling for the short put option, you assume the obligation, not the choice, to buy the underlying when the put buyer exercises his option. Now, let's discuss something else that's very essential for options trading: options pricing. If you have had success beating the market by trading stocks using a disciplined process, anticipating a nice move either up or down, and if you are one of those many traders who have also gained the confidence to make money in the stock market by identifying one or two good stocks poised to make a big move soon, then there is definitely a tremendous opportunity to earn more investment income and gain larger, more consistent profits. Maybe you anticipated the rise in peaks of Amazon, Netflix, Roku, Costco, Facebook, Snapchat, Twitter, GameStop, AMC, Pinterest, Nike, etc., just to name a few. But you don't know how to take advantage of that movement. Or what if the market, the stock, turns in the other direction? If you don't know how to take advantage of an unfavorable market, an up and down market, then your portfolio might be lacking by missing out on better opportunities for growth. If this sounds like you, maybe it's time to consider using options. So when making the transition from trading stocks to trading options, it's very important to understand how options are priced as well. Thus, it's essential to understand how options are priced and how an underlying stock movement impacts the options price. I'm sure you're wondering, well, what factors cause an options price to go up or down? Option prices are affected by three factors: price, time, volatility. These three factors that cause an options price to go up or down. In addition, these three factors affect option prices, and you must know each key term to understand how options are priced. Thus, when trading, notating key details about these three factors and the effect on your options price is essential and key for you having profitable trades. First, the price of the underlying stock. Second, the amount of time left until expiration. Third, levels and volatility of the underlying stock. But how sensitive will an options price be to each of these factors? Well, for those answers, you'll need to join Mo Investments Trading Academy, where our exclusive membership gives you the edge that will allow you to be more consistent and way more profitable. Our content and guidance will show, teach, and thoroughly explain how to understand each of these factors, sensitivities, and tendencies of options trading. Furthermore, we will help you limit risk and generate bigger returns. I'm sure at this point you're thinking, what? Stocks, options, volatility? It's too much. But like any investment or business, there's typically always a learning curve and takes time, dedication, and commitment to grasp everything. That's why it's critical to have mentors and guidance so you can navigate all of these challenges. Mo Investments Trading Community will provide you all the knowledge, research, and support to be successful. Remember, other important things to note for options: intrinsic value, using options pricing to determine how in the money an option is or how much profit currently exists. Simply, it's the in the money portion of an options price. What is an options value at expiration? Well, to help understand this, you need to know intrinsic value, the difference between the stock price and the strike price. An options value will be determined by how far in the money it is at expiration. In the money options have intrinsic value. Also, if you made it this far, please like and subscribe. Here's an example of calculating the intrinsic value for options pricing. However, note, there are some downsides to intrinsic value because calculating the intrinsic value of a company is subjective since it estimates risk and future cash flows. Also, the intrinsic value of an option is incomplete since it doesn't include the premium paid and the extrinsic time value. Extrinsic value measures the difference between the market price of an option, called the premium, and its intrinsic value. Extrinsic value is also known as time value because the time left until the option contract expires is one of the primary factors affecting the option premium. Under normal circumstances, a contract loses value as it approaches its expiration date because there is less time for the underlying security to move favorably. For example, an option with 1 month to expiration that is out of the money will have more extrinsic value than that of an out-of-the-money option with 1 week to expiration. Extrinsic value simply measures the amount by which the option's price is greater than its intrinsic value. No time left, no time value, no extrinsic value. Note, factors affecting extrinsic value. Extrinsic value rises with an increase in volatility in the market. Another factor that affects extrinsic value is implied volatility, or simply IV. Implied volatility measures the amount an underlying asset may move over a specified period. If the implied volatility increases, the extrinsic value will increase. For example, if an investor purchases a call option with an annualized implied volatility of 20% and the implied volatility increases to 30% the following day, the extrinsic value would increase. Out-of-the-money options that have a strike price that does not allow you to buy or sell the underlying stock at a better price than the current market price are worthless if there is no time left. Why will out-of-the-money options be worthless at the expiration date? Well, because for out-of-the-money calls, nobody is going to want to buy stock at a higher price than the current market value. For out-of-the-money puts, nobody is going to want to sell stock at a cheaper price than the current market value. If out-of-the-money options won't have value at expiration, then why would they have value now? Because stock prices move, and if there is still time left until expiration, then there is a chance that an out-of-the-money option could become in the money. Out-of-the-money options are worthless. Thus, when trading out-of-the-money options, you should have done the appropriate research and your due diligence, because typically profiting from out-of-the-money options takes very elite, skilled, and knowledgeable trading experience. If you lack the expertise or skills of an elite trader, then please join our trading education group community. Mo Investments gives you the edge that will allow you to be more consistent and way more profitable by leveraging the research and knowledge of elite traders. You can piggyback and mirror profitable trades, saving you time and, most importantly, saving you money. If you follow and stay dedicated to our educational guidance, you will be highly successful. It's our better trader guarantee. Time decay is a certainty. Option prices are always decaying due to the passing of time. Note, you can choose to fight time decay, risking an in-the-money option profit, become out of the money and worthless, or have time decay benefit you. Buy short selling options while they still have value and before they become worthless or out of the money for easy profits. Overview comparison chart of call buyers and sellers. Call buyers, maximum gain, unlimited. Call buyers, maximum loss, premium paid. Call buyers, break-even point, strike price plus premium. Call buyers, want option to be exercised. Call sellers, maximum gain, premium received. Call sellers, maximum loss, unlimited. Call sellers, break-even point, strike price plus premium. Call sellers, want option to expire. Overview comparison chart of put buyers and sellers. Put buyers, maximum gain, strike price minus premium. Put buyers, maximum loss, premium paid. Put buyers, break-even point, strike price minus premium. Put buyers, want option to be exercised. Put sellers, maximum gain, premium received. Put sellers, maximum loss, strike price minus premium. Put sellers, break-even point, strike price minus premium. Put sellers, want option to expire. Overview comparison chart of impacting factors for options pricing. Intrinsic value equals the premium paid plus extrinsic value, and vice versa. The premium paid equals extrinsic value plus intrinsic value. Other key notes for my statistical investment nerds who love studying all aspects of statistical models, mathematical models, and technical analysis, option Greeks, etc. Option contracts can also be priced using mathematical models such as the Black-Scholes or binomial pricing models. We have something for all of our fellow option geeks to research, so check out additional content covering all these topics too soon. Now let's break down the return on investment for playing both sides of the trade for call options. We will break down different scenarios showing how buying long calls and selling short calls can generate profits as well as cause a loss. Because calls are typically the first and easiest concepts for people to grasp, we will just focus on the return on investment for calls in this video. Sorry puts, but honestly, Over time, you will grasp return on investment for both calls and puts much faster once you start implementing different bullish and bearish strategies. Situation: let's assume a company's shares have a current market price of $100. An investor wants to purchase a call option with a strike price of $110 and an option price of $5. Since call option contracts include 100 shares, the total cost of the call option would be $500. There are 3 outcomes when buying a call option: taking a loss, breaking even, and making a profit. In order to explain the potential outcomes, we will explore 4 different scenarios using the return on investment call option formula. Before we start, it's important to note if the underlying stock moves in the wrong direction and the options are out of the money at the time of their expiration, they become worthless and the trader loses the premium they paid for their option. Now, let's break down the first scenario. The investor takes a complete loss. The underlying asset is trading at $105 at expiration. In this example, the buyer will not exercise the right to purchase the underlying shares because the strike price is higher than the market price, meaning that they will be overpaying for the shares. Therefore, the option is worth nothing when it expires, and the buyer will lose their entire $500 investment. The return on investment will be calculated as follows. When you earn nothing from an option contract, that's $0 minus your initial $500 investment divided by 500 equals -1, multiplied by 100 shares equals -100% return on investment. Thus, the buyer of the call option will lose 100% on their investment. Second scenario, the investor takes a 60% loss. The underlying asset is trading at $112 at expiration. In this example, the buyer would exercise the option to purchase the shares for $110 and immediately sell them for $112. In this case, they would earn $200 in profit. The $2 increase in price multiplied by 100 shares. But since they paid $500 to buy the option in the first place, they will take a loss of $300. The return on investment will be calculated as follows. When you earn $200 from an option contract, that's $200 minus your initial $500 investment. That's -$300 divided by 500 equals -0.60 multiplied by 100 shares equals -60% return on investment. Thus, the buyer of the call option will lose 60% on their investment. Third scenario, the investor breaks even. The underlying asset is trading at $115 at expiration. In this example, the buyer would exercise the option to purchase shares for $110 and immediately sell them for $115. In this case, they would earn $500. The $5 increase in price multiplied by 100 shares. And since they paid $500 to buy the option in the first place, they would break even. The return on investment will be calculated as follows. When you earn $500 from an option contract, that's $500 minus your initial $500 investment. That's $0 divided by 500 equals 0 multiplied by 100 shares equals 0% return on investment. Thus, the buyer of the call option will neither lose nor gain money on their investment, called breaking even, aka break-even point. Fourth scenario, the buyer makes a profit. The underlying asset is trading at $130 at expiration. In this example, the buyer would exercise the option and purchase the shares for $110 and immediately sells them for $130. In this case, they would earn $2,000. The $20 increase in price multiplied by 100 shares. Since they paid $500 to buy the option in the first place, they would earn $1,500. $2,000 minus $500. The return on investment would be calculated as follows. When you earn $2,000 from an option contract, that's $2,000 minus your initial $500 investment. That's $1,500 divided by 500, which equals a positive gain of 3.0 multiplied by 100 shares, which equals a positive 300% return on investment. Thus, the buyer of the call option will earn 300% on their investment. Visit us at moinvestments.org and sign up to join our trading community now. Become an elite trader, earn consistent income, and build your generational wealth executing profitable options trades. Stay tuned for more Trading Academy content. We can't wait to see you in the next video. And don't forget, please like, comment, share, and subscribe. To join, just go to moinvestments.org/collections/all for membership offers and info about how to sign up to start your investment journey now. Follow us at Mo Investments on all social media platforms to see profitable trades, investment insight, profit performance postings, as well as free giveaways. Video disclaimer: Mo Investments is for educational purposes only. We do not force any investments or trades, and you are to use your own due diligence when investing or trading. Results are not guaranteed. Past experiences are not indicative of future results. Always invest and trade with an amount that you are comfortable with losing and that you will not jeopardize yours or someone else's financial well-being. Mo Investments is not a financial or investment firm, and all signals are to be used knowing they may or may not be accurate. These videos are for educational and entertainment purposes only. Any content used for our videos should not be construed as financial advice or any recommendation to buy or sell any sort of security or investment. Please consult a professional financial advisor before making any financial decisions. Investing in general and options trading especially is risky without proper research, knowledge, and due diligence.